Hello, I'm Tony Cordato,
And I'm Peter Kukulis.
and we're here to talk about property. Well, talking about purchasing an investment property and talking about what's the best loan to get when you're buying an investment property.
Very good question.
Go for it.
All right. So basically, when you're buying your first investment property, we'll start off with the first investment property. You want to look at a couple of options. Do I need the loan to be a variable? Do I need the loan to be a fixed rate? Do I need the loan to be a principal and interest or interest only? So they're the four major ones that we look into. Then we break it down. We basically sit down with our clients and say, okay, it's your investment property. We look at incomes. And let's say, for example, I'll just give an example. We've got a customer that's earning $190,000 a year and the wife is earning $80,000 a year. So we've got two different incomes. When we sit down with a client to say, okay, you're buying an investment property, is it brand new or is it an older style property?
Good point.
Okay. If it's brand new, then we sit down and say, okay, for the depreciation and tax benefits and everything else, we suggest that you put more percentage of the title, the share percentage, on the higher income earner, maybe 80% and 20% to the wife. So then they get more tax benefit.
Well, they get 80%
of the tax benefit.
tax benefits and 20% for the lower income person.
Correct. Yeah.
Yeah, and I mean, depreciation can be like $10,000 a year.
Yeah, depending on the property, yeah. If it's a dual key, it could be even more.
And that just is a reduction
Of your tax.
of your tax
Yeah.
without paying a dollar.
That's right. So
That's-
instead of paying, for example, the ATO, an extra 10 grand, you might as well buy brand new property and then save that 10 grand in your pocket.
And just have it as a tax deduction that you don't have to spend a dollar for,
Correct.
ongoing dollar. You pay for it up front.
Absolutely. 100%.
So
100%.
there's that, and then of course there's the interest.
The interest, yes.
Also, like if the husband's got 80% of the loan, he pays 80% of the interest.
Correct, yeah, yeah.
Mind you, he gets 80% of the rent.
Of the rent as well, yeah. So it's all 80-80. However, with the banks, we can actually have the loan as 50-50
Yeah.
on the loan, but the title deed is where you get the tax benefits.
Yeah.
So that's the accountant will sit down and do all that. So moving to the next stage of the actual loan, then we look at, okay, if it's brand new, do we look at an interest only for a 5-year period max and just paying the interest? Or do we start paying down the debt? It all depends on the client's circumstances. So as I said in my previous videos, it's like a tailored suit. We don't just go, here's the loan, you need to have an interest only, you need to have this, that. No. We sit down and say, okay, you've got an owner-occupied home.
Yeah.
You owe $500,000, property's worth $3 million. Fantastic. You've got plenty of equity. So why don't we use that equity and then borrow 100% of the new property plus the cost,
Yeah, that's true.
and then if it's getting built, like a house and land package, add the interest for that 18 months.
Yeah.
So then you've got the whole tax deduction of the whole lot using the equity. And then we do it as interest only for 5 years. And then if it's positive cash flow, for an example, if the rates were 2%, it would have been positive cash flow. Then we take that positive cash flow, let's say $100 a week, and we put that in your owner-occupied home to pay down your debt on your owner-occupied.
Yeah.
Because the problem is that with your owner-occupied home, when you leave home and you go to work or to the office, wherever you're going, that property is only giving you capital growth. Excellent. But there's no return on your investment.
No
No
income,
income.
no
No money.
No income stream. Oh.
So you want to pay down your owner-occupied as quickly as possible, and then later on you can use that property as equity and buy multiple properties.
That's the point.
So using that sort of methodology. But we tailor it to each individual client's needs. So coming back to the four that I mentioned, we've got principal and interest or interest only. On a principal, you're paying down the debt. However, if you've paid down your owner-occupied debt, then we suggest to pay down the investment loan as quickly as possible. And then we look at other avenues as well. And then you've got variable or fixed.
Yeah.
Now, with variable and fixed, if you're fixing a loan, the interest rate.
Yeah.
So if you're fixing a loan, if the variable rate is, let's say, 6.5%,
Yeah.
okay, as of today, and then you're going to fix it at 7%, why would you pay 0.5% more to the banks to make more money for them instead of your pocket? So I say to them, look at a variable.
Yeah.
Unless you want that certainty of the repayment, then we say don't do it for 5 or 10 years fixed. Do it 1 or 2 years and let's review it.
Oh, there is an exception. When interest rates are very low,
The other way, yes.
then it's a great idea to fix rates.
Absolutely. Like we've had clients that they fixed rates for 3 to 5 years at 2% or 1.89, and now the rates are 6.5%. But there's a problem with that as well.
Tell me.
The problem is it's all the mindset, because we had the cheapest rates and people fixed it at 1.89, 2%, 2.2. That's fantastic. Now everyone's coming off the fixed rate and they're going to 6.5%, and they're going, oh my God, my repayments are going to be 3 times.
Yes, that's the trouble.
And it's the mindset. It's not the repayment, it's the mindset shift, the shift of the mind going, oh my God, and you start freaking out.
Well, maybe it's time to sell.
And maybe it's time to sell. But the point I wanted to make is with the fixed rates, if the fixed rate is cheaper than the variable, yes, we can split it, we tailor it, fix a portion variable. So it's all about tailoring it to the client's needs. Yeah, absolutely.
Yeah, that's great. Okay.
Excellent. Thank you, Tony.
Well done.
Thank you, everyone. See you in the next one.